Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Monday. It's May 23rd. It's about 8:01 in the morning. The market's going to open up in about an hour and 29 minutes. The Dow is rallying hard. The NASDAQ is opening up pretty good. Most of the rally, I'm believing, is from Friday's upside when Bullard said that the economy is not in a bad shape. I'm paraphrasing him, but it's how the plunge protection team, as Jeff Zananeri likes to call it, begins its work. When they start getting worried about the market, or the fact that the public is getting worried about the market, they start bringing in bullish commentary, which is what he did on Friday, and it really caused a good rally at the end of the day. But that was the Fed. That was Bullard reassuring that the investors that the economy is stable. Or something to that effect. Again, I don't remember the exact terminology. Now, this week we've got a big week, but one thing I want to talk about last week, one of the biggest things that we're watching right now is cryptocurrencies breaking down. Cryptocurrencies don't have any intrinsic value, and there's a lot of speculative money in that. So if cryptocurrencies continues breaking down, that may destabilize slightly the stock market, especially the tech sector, some more. So keep your eye on the cryptocurrency sector, because there is some relationship between that and stocks. Also, if people have a margin call on their crypto account, they may be selling their tech stocks to overcome that burden. So just keep aware of that. The crypto breaking down on us last week is not a positive sign. It's a weaker sign for the global economy. The other major sign is last week's existing home sales. We had the lowest levels, since before COVID started. Now, economists are playing it down, saying that there's just not enough inventory. I'm hoping that's the case, but typically that's how it starts out, as a real shocker. And it's about time, and it would coincide with the fact that rates are going higher. So there may be a sell-off in the real estate market, and if that begins to happen, or a slowdown in the real estate market, if that begins to happen, it shouldn't be a major surprise, since we've been seeing really, really strong housing market for a long time. Now, again, it'll be very interesting to see if we can sustain this rally, because this would undo pretty much all the downside that we had on Friday, and I'll get into that in a bit. Now, in terms of what to watch this week, you've got the FOMC minutes, and you've got GDP. This report right here, the GDP is going to tell us if the economy is humming along or if it's slowing down. If it's slowing down, whether it's moving into the recession territory or whether it's still stable. Now, those are the major reports. There's going to be a couple of others like new home sales, but quarter to quarter, we're now expecting negative 1.4%. 1.5 to the downside, 1.2. It's getting narrower, which is positive. Not that it's negative, but the fact that it's getting narrower. Now, personal consumption expenditures. This is going to be really interesting. Notice how it's all over the board. If we show that personal consumption expenditures are high, that means consumers are spending. That's a very, 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 very bullish sign. So I want to see the personal consumption expenditures and see if it's better than last quarter, because if it's better than last quarter, and it's expected to be better than last quarter, that's a positive sign. So this is what's baked into the market. Quarter over quarter, negative 1.4, personal consumption, positive 2.9. But again, look at the range. That's the low end of the range. And if it's higher, well, the Fed's got some explaining to do, because usually during a bearish market, investors don't spend a lot of money. We also have durable good orders. That's going to be meaningful. So new home sales, we'll start off there. Durable good orders. PMI is not going to be as significant as consumer price index, as the CPI. Or this is the PMI, but durable goods orders, GDP, international trades in goods and services, obviously income. But FOMC and GDP are going to be the big ones. Now, what we need to do is keep our eye on the bond market. Now, I started talking about this a long time ago, and boy, the divergence is there. But look, since Ford, almost over a month, 5 weeks now, we've been seeing choppiness in the bond market. Keep in mind, if the bond market can't go lower, that means interest rates, long-term rates are not going higher. And that means the market is not assimilating higher rates for the stocks, and that's bullish for the stock market. Also, let's not kid ourselves. We went from 154 to 112, okay? So it's not like we haven't gone down. This is a huge downside, and I believe this prices in any sort of near-term inflation we're going to see in the long bond. I mean, look at this, from 155 to 112. So I'm expecting some upside, maybe some movement against the trend, maybe the 122, 125 level, and then we can short it, but not right now, not yet. Put the call ratio still over sold, folks, which means the markets are set to go higher, not lower. Look at this. Look at this. Even when we come down to here, we can't go down to overbought, which means there's more puts winding us up, winding us up, winding us up. Volatility, we could not sustain. Notice, we went lower last week. We broke the low. Look at that, right? Lower, lower. And on the QQQ, we went lower. But volatility completely, look at that, completely. Not divergence too, but volatility completely shrugged it off. Look at that. We couldn't go higher than the previous week. That's a very, very bullish sign. Basically, volatility and put to call ratio is telling us we're going to have a nice juicy rally. The bond market is telling us the same. And we've had now 2 weeks of the sector that's lagging behind the most, leading us the XLY, and the small caps are no longer lagging behind the broad market. They're actually taking us above the broad market. So there's some very, very bullish signs developing on the underground current. Now, talking about the economy, the broad economy, let's talk a little bit about that, and then I'll get into sectors. On Friday, the S&P dipped more than 20% below its peak, officially a bear market, but it finished at 18.7% below its record. So we're not in a bear market yet. That capped 7th straight losing week, the longest since 2001 when the dot-com bubble was deflating. And I'll show you momentum levels. Actually, I'll show you momentum levels right now. So you could see that it's exactly the same thing. The momentum levels, the put to call ratio, everything is pointing to a nice juicy reversal to the upside. Let me show you this. Look at that. Folks, this is 2008. This is COVID. Look at where we're at right now. Do you really think we're going to go a lot lower? I don't think so. Now, I never said I'm going to pick the exact low, but once we started breaking lower, I said we're getting there. And since then, we haven't lost all that much value. Now, with put to call ratio, with momentum levels down here, with the stock market in the toilet, let me continue reading this. Inflation, rising rates, the war in Ukraine, China's slowing economy are all pushing stocks and rising fears about a possible recession. I think if we're going to have a recession, it's not going to be at least for another 1.5 to 2 years. Investors are looking ahead to the release of the minutes from the latest policy meetings. That's coming out this week. That's coming out on Wednesday at 2 p.m. Eastern time, just kind of going back and forth to show you the lay of the land. Many tech stocks, some of the most vulnerable to rising rates, and cryptocurrencies have fallen more than 20%. This includes 37% on Tesla and 69% on Netflix. Netflix might be justified. I'm not sure about Tesla. With inflation at its highest level in 4 decades, and there's some shred of evidence that it might have peaked, the Fed has switched from keeping interest rates super low to support markets and the economy, and it's raising rates and making other moves to tamp down inflation. The worry is it might go too far too quickly. We're on a razor's edge right now, folks. Goldman Sachs economists recently put the probability of a U.S. recession in the next 2 years, not 2 weeks, 35%. I agree with them in 2 years, not yet. Inflation has been particularly painful for months. Gasoline prices, this Ukraine business, gasoline pumps, grocery stores, grains, energies, basic materials. It's been a mess. So my theory is the put to call ratio and the VIX are pricing most of this in. And again, small caps are starting to rise, and the sector that took us there is no longer going down. And look at where we're at. I mean, this is nosebleed levels right here. We are basically not nosebleed levels. This is like can't breathe levels right here. This is really unsustainable. 91 stocks are trading below the 200-day moving average out of 100. That's huge. That's huge. Now, looking at the sectors, we still have the energy sector leading, and we have consumer discretionary lagging. You're welcome, folks, for putting it into the hedge for alpha rotation last week when we went down big. I know you guys made money on that. And if you did, send me love letters, support@marketgeeks.com, or post something below, a comment or a chat below this video. I want to see it. I'm going to be checking. Anyhow, things are looking like they're ready to bottom out at least a little bit. Energy sector looks fairly good at these levels. Looks like it can just kind of chop around here. Utilities looks like it's going to continue moving sideways, maybe a little bit higher. Healthcare looks like it's done going down and it wants to come up or chop. Basic materials also looks like it's bottomed out. Technology looks like it's going to bounce. I don't know if it's going to come up, but it's going to bounce. Notice technology and industrial made lower lows, but notice communicate and consumer discretionary, but notice communication services did not. So again, I think a lot of these stocks have bottomed out. I think real estate looks like it's going to go up for a little bit of a ride. I think healthcare, real estate and healthcare look pretty bullish here. Utilities look pretty bullish here. Maybe that's why the Dow is up 300 points. Financials, I think we're going to chop a little bit. Consumer discretionary and tech, we're going to build a base around these levels. But consumer staples looks like it's going to go higher just to bounce off of these levels. This is too much too fast. But I like real estate right here, and I like healthcare, and I like utilities around here. Now, those are pretty neutral sectors, healthcare, utilities, and real estate. So keep an eye. We may have a nice little turnaround before the end of the week. Now, looking at the S&P, we're opening up a little higher. Let me give you some major levels to pay attention to before I let you go today. Folks, I really think, and again, I don't know if we're going to start rocking and rolling, moving higher, but I think the market has last week really showed its hand in terms of going down. And again, the divergence levels just can't sustain this. Look at this. RSI on this low couldn't even go to 34. I mean, this is craziness right now. Crazy low levels. So I would love to see us go from the 396 to the 430 level. I think that's going to happen. I think that's going to be the first thing that happens. First, we'll need to pass the 415 levels on the SPY, but I think that's coming up next. On the QQQ, we got to take out the 307.22 level, and then the next is going to be the 50-day moving average, which is at 331. So 306, 331, and then we'll see if we can go above the 200 or hit 200. But I think for now, we should be very focused on the channel. Let me just draw a channel for you here. And if we can get past this channel right here, we can go above these levels. But I think that's the first thing. We need to go above 307.10 on the SPY. Again, folks, this is going to be a very tumultuous, very volatile week. We still have, by the way, I thought I was done, but I'm not done yet. I always have more. Monday, Advanced Auto Parts earnings. They're expecting $3.57. I would write these numbers down. Tuesday, we've got Bed Bath. Is this BB? Let me see what BBY is. Is it? Always confuse those two stocks. Whoops, excuse me. Bed Bath and Beyond. I confused that with Best Buy. They're expecting $1.63 share and earnings at $10 billion. Bed Bath and Beyond is a good home type of stock, so we'll see how that's impacting us. Same thing with Big Lots on Friday. They're expecting $1.09. Wednesday, you've got NVIDIA. That's probably going to be the biggest news report of the week. We're expecting $1.30 per share. A good earnings per share number. And I think this is going to cause the techs to start rallying. So I wouldn't be selling NVIDIA right now. I'd probably be buying chip stocks right now. They're expecting a good number. We've got Dollar General on Thursday. That can go either way. They're expecting $2.33, and Friday, Big Lots. So keep your eye on those numbers. Now, before I let you go, folks, the stock market recent sell-off has left many traders scrambling, but not my team. We're playing the lows. That's because I created a trading strategy with the initial purpose of using it for a bull market, but it ended up working even better in a crashing one. These tough times, folks, these tough times are exactly what the system ordered. I mean it. I'm not kidding. And I decided to host an urgent trading session at 1 p.m. Eastern Time on Tuesday, May 24th. That's tomorrow. To give everyone the details of how it works and show you how you can make consistent money in this type of market if you know what you're doing. Click on the link below and get access to secure your spot. Go to the sign up page for the event. Tomorrow, strongest sector, strongest stock, weakest sector, weakest stock. Again, don't miss tomorrow's class. It's going to be all meat and potatoes, no monkey business. You guys are going to love it. I'm expecting a nice juicy rally this week from the market. We've had really, really nasty downside. Expect a good rally. Follow the link below. Check me out tomorrow at 1 p.m. Eastern Time. Now, I want some comments. I want some feedback. I think we're approaching the low right now, at least a swing low. I think the market's going to go higher. If you're getting value out of these videos, send me some love letters, comments, feedback. Send me an email, support@marketgeeks.com. Want to hear from you and like these videos. Bye, guys. Join our Telegram channel, too. Bye, guys. Have a great week. This is going to be a very, very interesting week because the market's oversold, it's diverging, and everything is pointing higher. Fingers, toes crossed.